For nearly 8 decades, the US dollar has reigned supreme as the backbone of global finance. It has been the world's primary reserve currency, the standard for international trade, and the benchmark for commodities like oil and gold. But today, cracks are beginning to show in that dominance. Nations across the globe are asking, is reliance on the dollar sustainable, or are we moving toward a new global currency system? The dollar's supremacy was born in the aftermath of World War II, through the Bretton Woods Agreement of 1944. Global currencies were pegged to the dollar, itself backed by gold. Even after the US abandoned the gold standard in 1971, the dollar retained its central role, strengthened by America's economic might, military power, and the petrodollar system, where oil was priced and traded exclusively in dollars. This gave Washington enormous leverage, the ability to impose sanctions, influence global markets, and finance deficits at low cost. But the landscape is shifting. The dollar's share of global foreign exchange reserves has fallen to its lowest level in decades. Countries like China, Russia, Brazil, and India are increasingly trading in local currencies. US sanctions on Russia have accelerated efforts to bypass the dollar altogether. And new technologies, like central bank digital currencies and blockchain systems, are opening doors to alternatives that were unimaginable just a generation ago. So what could replace the dollar? The Chinese yuan is gaining traction, especially in Asia, Africa, and Latin America, backed by the world's second-largest economy. Yet China's strict capital controls and lack of transparency limit its global appeal. The euro remains strong in Europe, but political fragmentation and recurring debt crises undermine its credibility as a true rival. Gold, timeless and universal, is increasingly favored by central banks as a hedge against volatility, though impractical for daily trade. Digital currencies, particularly China's digital yuan, promise speed, transparency, and independence from US systems. And the BRICS bloc has floated the idea of a shared currency to challenge dollar hegemony, though political and economic differences make that vision difficult to realize. Still, the dollar retains powerful advantages. It dominates global bond markets and foreign exchange transactions. Investors continue to trust US institutions more than rivals. And the network effects of decades of trade invoicing and financial contracts make switching costly and complex. The likely future isn't a sudden collapse of the dollar, but a gradual erosion of its monopoly. Instead of one currency replacing it, we may see a multipolar system emerge, different regions relying on different currencies, while gold and digital assets serve as global hedges. This would reduce US dominance, but also create a more fragmented financial landscape. The decline of the dollar is not the end of American power, but the beginning of a new chapter in global finance. A chapter where financial influence is shared, not centralized, and where nations must navigate a world of multipolar money, with all the opportunities and challenges that come with it.